One of the rookie mistakes I've made when I started out investing was focusing on the share price of a company. On the surface, one might think it's one of the most important criteria for buying stocks, since it's always the first thing you see in most financial graphs like those on Yahoo Finance or Seeking Alpha. In this video, we'll break down why share price is not that useful and what metrics you should be looking instead when determining whether a stock is a worthwhile investment. Before we jump into the details, do note that I am not a licensed financial advisor. None of this is financial advice. I'm simply presenting our research and opinions for fun and educational purposes. Share price is misleading for a couple of reasons to new investors. Number one, the smaller the number, the more attractive an asset might seem. This applies not just to stocks, but cryptocurrencies as well. I believe that's one of the reasons why meme coins like Doge and Shiba Inu are able to pump this much during a bull market. Share price is also a factor when companies go through initial public offerings, also known as IPOs, because lower share prices allow more investors to participate, whereas for companies with huge share prices, such as Berkshire Hathaway Class A shares, there is a barrier to entry to small retail investors, unless their brokerage supports fractional shares. However, this does not mean a low share price is a good deal. Remember that ordinary shares in a company are just tiny fractions representing your ownership in that company. Hence, what you should be looking for should be the total market capitalization, representing the value of the company according to the stock market and the number of outstanding shares. Market capitalization, or market cap for short, is important because there's a correlation between size and growth. Generally speaking, a small cap company is able to grow more quickly than a large cap because growth is relative. Small companies might find it easier to double their number of customers, whereas a big cap company like Apple will need many things to execute perfectly in order to double its number of customers. As for the number of outstanding shares, think of it as how many pieces of a company are divided up. For example, if a $10 company issued 10 shares with $1 worth of shares, you essentially own 10% of the whole business, meaning you are entitled to 10% of its profits or losses, its assets and its liabilities. But if the same $10 company started issuing out more shares, let's say it doubled the number of shares and now it has 20, the same $1 you paid for that company is now worth only 5%. This is known as dilution, which reduces the value of your stocks, similar to how money printing causes inflation, reducing the value of your dollars. So the best companies aren't the ones with the most increase in share price. Rather, they increase in market capitalization and keep their number of outstanding shares stable or decreasing. So the next time somebody tells you a company is great because of its price action, look closer at the market cap and the outstanding shares instead. Price action might be fun to follow, but it's more important to know how much of a business you are buying for that price. Of course, there are plenty of other useful metrics to value a company, such as price to earnings ratio, the debt to equity ratio, free cash flow. We plan to create more content on these financial metrics, so remember to subscribe, and while you're at it, drop us a like and comment on which financial metrics you wish to learn about. We will see you in the next video.